Good morning, ladies and gentlemen. I'm Gareth Alston, the Deputy Chair of the Investment Analyst Society, and again, it's my pleasure to invite you to welcome you to Mara Delta's results presentation. Thank you very much to Sandile, Bronwyn, and the team for hosting the society again. We really do appreciate these presentations. I think over the past few weeks it feels like we've been doing nothing but having results presentations. It's been that busy time of year, but I think that's what analysts live for. Definitely been a very busy year for Mara Delta as well. Obviously, we go back a year, the company had a different name, involved in the same business, but I think there's been some very interesting developments within the company that I think we all look forward to finding out more about today, and especially finding out what the future plans for the company are. I'd like now to hand over to Bronwyn Corbett, and thank you very much again for presenting.
Thanks very much, Gareth. Just to introduce a couple of people here today, including myself. Hopefully you know who I am. I'm the CEO of Mara Delta. We have our Chairman, Sandile Nomvete, here today, so thank you for joining us. And we have our CFO, Leon van der Moertel, make sure I pronounce your surname correctly, who will be presenting on the financial numbers, and Heidi Ricks, our Chief Operating Officer, who feels like she's been here for 5 years, but it's not as long as that. So all of our execs are in the room today. It's quite an exciting day for us because we've never presented at the JSE. We've always released results in Mauritius. So we thought we would turn things on their head this year and come through to the JSE. So thank you for the welcoming in that. So it's always good to be the CEO of a fund when you're able to announce fairly good results. Considering what has been going on in Africa and the current challenges, we've obviously seen what's happened in West Africa, the oil and gas challenges, and a fund like Mara Delta has proven to be quite resilient to a lot of the risks and a lot of the challenges that we've seen on the continent at the moment. So I think, considering the macroeconomic landscape of Africa, I think we have produced, well, I know we have produced an excellent set of results. And been able to achieve ahead of our forecast distribution, been able to achieve a solid dividend, dollar dividend, as well as the growth, and forecasting an excellent growth going forward, just solidifies our story. And, the big thing is, what is the Mara Delta story? And I think it's important to understand that we are counterparty. And I cannot say this enough. One of our board members said he didn't even know what a counterparty was until he came onto our board. But the reality is that having the strength of a counterparty is that if the macroeconomic challenges face a particular country, counterparty is what gets you through that. And we've seen it in Mozambique. So Mozambique, you've had the IMF withdrawal, you've had challenges around the macroeconomic, you've had challenges around the political environment. But because of the strength of our counterparty, we've been able to draw out dollars out of Mozambique, and we've been able to continue business as usual. And I need to reiterate that, because what's important is that people tend to say Africa's a mess, so everything is a mess. And it's important that each story and each business you look at individually. The other aspect that we have is PRI cover. So we've taken a view to have extensive PRI cover in some of these geographies. PRI cover costs us up to 1% of the asset, which is very, very expensive and quite dilutive to distribution. But what it does do is that it covers dollar liquidity, it covers expropriation of funds, so we mitigate the risks that sit into these various jurisdictions. So again, what is the strength of Mara Delta? We have been able to build a business in a very challenging macroeconomic environment. We've been able to keep on the counterparty, and you'll see a slide that depicts this later. And again, we've been able to build a management team that has extensive experience on the continent. And I promise you, the term "the continent" isn't for sissies. I can show you as hell it's not. Last week, this time, I had slept for 2.5 hours trying to get to a flight to Eldoret, which is in the middle of Kenya. And I can tell you that no matter who you are in the business like Mara Delta, you have to be on the ground. You have to understand the local partnerships. You have to understand what is going on, whether you sit at executive level or anywhere else in the business. So just from a Mara Delta at a glance perspective, you will see that we listed at just over $220 million. We've grown the portfolio extensively. Our location has expanded into Zambia, Mauritius, Kenya, with a big focus of ours being on East Africa. You'll notice that Nigeria has fallen out of that. What the current redefine pivotal transaction has been able to give to us is the ability to exit wings. I think some of our shareholders will know my views on Nigeria. I think the Nigerian market cannot be ignored, but for an income fund, a distribution fund like Mara Delta, we cannot invest into Nigeria at this stage. Dollar liquidity, expropriation of funds, all of those things are massive challenges that we wouldn't be able to deal with going forward. So we had the ability to exit Wings, which I still think is a very good asset. I think it's one of the best assets in Nigeria. And I'm not just saying that so that Jackie can hear me, Faniko. But the reality, it's an excellent asset. But for us as a dividend yield play, it doesn't suit us at all. So we see no further expansion into Nigeria. We are very focused on East Africa. We're seeing some excellent opportunities in Mauritius with strong counterparties, sale and leaseback, pure hard currency leases, which is giving us huge opportunity to expand into Mauritius. You would have recently seen the announcement of Tamasa. Tamasa is owned by the Lux brand. The Lux brand is a formidable counterparty in Mauritius. We've been able to sign a triple net lease without taking any operating hotel risk, a pure sale and leaseback opportunity where they're going to be injecting those funds into the growth and to the redevelopment of their particular portfolio. Euro lease, critical. Hard currency lease, no risk of that reverting back into rupees or any local currency, which is critical. You will see that our occupancy rate is sitting at 93%. That has come down, and it's been really around the Moroccan ANFA transaction. Our entire portfolio, bar one or two vacancies, and Heidi can obviously mention those to you later, is 100% occupied. We have no arrears on any of our buildings. Morocco has been one of our challenging assets. Again, it's my reluctance about big retail on the continent, which scares me. What we are doing is we're doing an upgrade and redevelopment. We have all the Turkish brands. We've had LC Waikiki already committing to coming into that centre, which we've now kept these vacancies for those particular Turkish brands. Morocco is a very interesting market. So all the Middle Eastern brands like Al Shaya or Al Okeh that carry H&M and all the big brands that we love to see cannot get their price points right into the African market. But the Turkish brands have very favorable trade agreements, and you're able to get the same quality that you're getting out of an H&M, but 30% cheaper. And Morocco, as sexy as Morocco is, and Casablanca and all these great things, is very price sensitive. And again, the African market is very price sensitive. And I think a lot of the guys that are building this big these regional centres are really realizing how price sensitive it is. So the highlights for me is obviously the most imperative part and what I'm very excited at bringing forward today. So I think the forecast distribution and being able to achieve the 4.1% increase in distribution per share, sitting at $11.75. Again, this is a dollar distribution, dollars. You know, the number of times I get asked about rands, remembering we are a reporting dollar fund. We have two primary exchanges, one in Mauritius and one in South Africa. So this dollar distribution growth, I believe, is excellent in the current market. What differentiates Mara Delta for its investment into Africa against a lot of our counterparties you see going into Europe and UK and some of the other countries is that we see that annual growth on the rentals, 3 to 6% dollar dividend growth annually. And I think that is critical, where a lot of those countries aren't seeing those escalations. So we are seeing those escalations. We are also making sure that one of our points that I've put this year is around the exposure to quality tenants and also the exposure to hard currency, euros and dollars, and also the ability to sustain those euros and dollars. So again, small retail for us, being able to sign lower rentals and being able to sign those particular tenants in hard currency is critical to the sustainability, not reverting back to the local currency. We've seen what the Mets has done. We've seen what the Naira, we've seen what the CD has done, and it's about mitigating risk in relation to those currencies. I have to say that the finance team has done an incredible job this year around the cost of funding. When Leon shows you a slide, and I know Standard Bank is in the room, but you'll see that we're exposed to many more banks across the continent, which is very exciting. We've got some of those banks here today. You'll see that our cost of funding has come down from 6.94 and goes down further, Leon, to 5.66 now in the new financial year. And again, if you're plugging that cost of funding into assets that you're acquiring at 10+% yields, you can see the positive carry from day one, which is absolutely critical. So you'll see that we're hugely multi-banked. The big realization on the African continent, some banks are in love with some countries and other banks are not in love with other countries. So the multi-banked approach is absolutely critical from a mitigation perspective. The property portfolio is obviously increased. You'll see that number slightly differs from the previous slide because the previous slide is post all the transfers that are currently underway. What we have been able to do successfully this year, and I chuckled this because the reality is that there's been a big arbitrage between our JSE register as well as our Mauritian register. That arbitrage has created a bit of a nightmare in relation to raising capital. We've still been able to raise $44.7 million USD at a 2.3% premium to NAV. And I think that's been critical because it hasn't created a dilution to our existing shareholders in relation to distribution and distribution growth going forward. We've got a nice slide just now which depicts the 90% exposure to A-grade plus A-grade plus tenants. And again, if I say it again, you'll hear me say it 100 times, strength of counterparty. And the occupancy rate have obviously gone through. This is a great slide because, it was mentioned earlier around everything that's happened in Mara Delta. So I think the reality is that a lot has happened. Some of our more formidable sort of timeline events can be depicted on the slide. I think now going through the process of having Pivotal exit as a shareholder, you would have seen the Redefine's announcement that Redefine's selling their assets in Mauritius, Kenya, et cetera, et cetera. I don't know if Redefine owned assets there, but obviously it's the shareholding structure. We have agreed with both Redefine and Pivotal that it won't create an overhang on the stock. It will be a gradual exit. We have identified a number of potential large shareholders that might look at taking up that stock. The management team and the board is currently working with those potential shareholders. So we're not too concerned. We all know Redefine's stance on Africa. Sandile and I will know that we've ended up with Redefine's two worst asset classes, government and Africa. So we're in an interesting place with Redefine at the moment. But the reality is that it will be an exit, and we have agreed that with Pivotal. So the main aspects now is to really look at who is our shareholder base, who has mandates for Africa, who's seeing the growth in Africa, the growth in our stock. And we've actually seen a lot of interesting propositions to Mara Delta, and I think it's because with everything that's gone on, we've been the only ones that have been able to create quite a nice platform for Africa real estate. There's a lot of competitors in the market that have tried to do it that haven't got the size, and a lot of them are looking at Mara Delta as now a platform for them to roll in their assets and look at a bigger business and being involved in a bigger platform. Again, size of balance sheet and all of that, and strength of having that multi-jurisdictional approach. It's the board has approved that over time that we would not like to be exposed to more than 20% to one country. I think that is critical. Guys, these are frontier emerging markets. Inevitably, one of them is going to take a wobble. I mean, I think it's just look at South Africa. Who would have thought what have happened to South Africa has happened here? But we're on the African continent. We're in frontier markets. So having that 20% cap to a particular market does give you that mitigant, which is critical to your real estate portfolio going forward. Just a portfolio overview. So we are now sitting with 12 assets in total. You'll see our exposure into Mozambique, Morocco, Zambia, Mauritius, and Kenya. Just to touch a little bit about Morocco, REIT legislation has now been promulgated. There will be a circular going around the formation of an asset management company. So we are in the process of converting our Moroccan asset with some other assets into a REIT. The intention is to take that REIT and then list it. So we would then own a strategic shareholding in a listed REIT going forward. Morocco is very exciting from a real estate perspective because they are a lot more forward-thinking than a lot of these jurisdictions around REITs legislation. They have modeled their REITs platform along with the French REITs law, which is quite favorable. So this will also give us a better tax-efficient structure. You need to remember that even though we behave like a REIT, we're not a REIT. So we pay tax in these jurisdictions, we pay withholding tax, we pay company tax. we're just actually doing a transaction in Uganda at the moment. We have over 2% tax leakage with withholding tax and company tax out of Uganda. So when we're not interested in the property yield. Yes, the property yield is important, but it's the post-tax return, the return back to investors in Mauritius, which is absolutely critical for us. And we've set that target at just under 7% dividend yield, which we think is an excellent dollar dividend yield. And it's critical that that is not dilutive to whatever transaction that we're looking at. We have obviously acquired the Zambian assets from Rockcastle, which has obviously come through. You'll then pick up that I think it's the weighted cap rate of the retail is probably lower than we would ideally like. But remembering in Zambia, you get 10-year tax holidays. So what we have done is that the ability to pay a better yield to Rockcastle because we're able to get that return back into Mauritius, which is critical to us. So the weighted average rental, again, a lot of the real estate in Africa has suffered because it's been over-rented. So what's happened is that a lot of guys have got into these markets. The markets have been booming. They've been signing leases in excess of, you'll look at Nigeria, $100 a square meter. Interesting enough, Wings then came down to $79 a square meter. There's a current deal in the pipeline at $46 a square meter. So you need to make sure that whatever asset you're acquiring is not over-rented at that particular point in time. Because when the market is under pressure, those rentals will inevitably come down, then you have rental revision challenges. So our weighted average cost of rental sitting at $23 is actually very, very good in a lot of these markets, and we're sitting probably at the lower end than the higher end in these markets. Just an asset overview from the post-current acquisitions. Anadarko building, we are doing Anadarko's phase 2. We are doing that on a development type perspective. Mara Delta does not take development risk, but because we own Anadarko phase 1, Anadarko phase 2, and because we've got a signed lease, we're now doing the development side of that. You'll see that the Barclays was one of our forays into Mauritius, now followed by, you'll see in our post announcement coming out around Tamasa. We are looking at similar type opportunities. No, we are not going into the hospitality sector. No, we are not taking operating risks. I saw a headline from a journalist the other day saying, Mara Delta now going into the hospitality sector, which terrified me. We're not doing any of that. Pure sale and leaseback opportunities. So this figure you'll see sits at the $358 million, which is where we will be sitting post these acquisitions. We have put out approximately $160 million of pipeline out into the market, which we are in the process of converting. A lot of our vendors are looking at taking shares, which is fantastic. So they'll be taking a view into Mara Delta. Again, what we're seeing in Africa is that a lot of guys will have a real estate portfolio in Uganda, or they have a real estate portfolio in Kenya. They don't want to exit real estate, but they want liquidity. And they want the ability to have multi-jurisdictional, having a multi-jurisdictional platform. So what we do is we will put their assets into Mara Delta with giving them shares at group level. So we're seeing a lot of transactions coming about, and also leveraging off our particular balance sheet, we're able then to secure better cost of debt, which is critical to the success of this. Again, quality tenant base. So I particularly put this slide in to highlight the brands and the guys that we are looking at, and the guys that we are currently having in our particular, whether it's offices or retail schemes. And the grading is absolutely critical. Heidi and her team have spent a lot of time looking at the grading. We've had a very, very detailed investment committee in Mauritius last week where, there's an opportunity for Mara Delta to bulk up quite extensively. But looking at some of these portfolios, the grade of the assets just does not work for us. We've done a very good job, maybe it's by luck, that we've been able to parcel some excellent graded assets. And it's our intention to continue on that basis. We don't want to pick up any overhang of assets that fall into B, C grade type assets. So that is absolutely critical for us. Leon, I'm going to leave the next few slides to you. Thank you.
Morning, everyone. Bron's always quite a difficult act to follow. So it gives me great pleasure to actually announce our results. It's been quite a year for us, and we've had quite a bit of growth. There's been very exciting movements, especially in the terms of the debt funding. So I'll just take you through the highlights, and we can carry on from there. So If you look at our net property income, 64% growth. A lot of that is on the back of the new investments that we've done, as well as the full year impact of certain of the assets that we bought in the last quarter of the previous financial year. EBITDA is up quite considerably. The distributable income also up 66%. The cost to income ratio is slightly up to 25.7, but there's a few once-off costs that I'll detail a little bit later. Property portfolio increase, you see there it's up 40%. Net debt up 51%, and our loan-to-value ratio is still staying within our range of between 45 and 50%. We still continue to enjoy quite strong support from our shareholder base, particularly the PIC, who's 28% shareholder. In addition, it's quite exciting to get a new shareholder in the top 10, which is Grindrod. And for ourselves, the management owning 6.9%, it's important to note now that 6.9% was not a free carry. These are actually shares that we've bought into this structure. We've had to gear ourselves to the hilt to be able to do this, but we've got a strong belief in this company that it will go ahead. In terms of the financial overview, we've already mentioned the distribution, 11.75 cents, up from the 11.28 cents. During the year, we had expected 11.63. We had a few additional once-off income that's pushed us to the 11.75. The cost-to-income ratio, as mentioned, there's a few once-off costs, which I'll touch on just now. Just wanted to touch on the NAV per share. You'll see it's dropped slightly from 168 to 163.27. This is as a result of the revaluation that we did on the Tenant Base shopping centre. With the redevelopment that's going to be popping up and the upgrade now, when we're doing the discounted cash flow, there's a period of 18 months during the construction that's impacted that valuation. Average rental escalations, 3.8, up from 3.4. You'll see that figure is going to stay in that range, which is quite exciting for the share price, which also generates growth in distribution. If you're looking at our distributable income statement, you'll see the property income 17 million versus last year's 10 million. Other income and income from associates, this relates to the investments that we've made in Zambia, where we own 50% of these assets, as well as the acquisition of the Buffalo Mall in Naivasha, where we own 45.5%. Admin expenses, you'll see there, has gone from 12% to about 16% of income. It's important to note that this is as a result of us bolstering the back office team. We've brought on Heidi Ricks, we've brought on Chanel, who's a country risk expert, as well as boosted the asset management team with some very, very competent skills, which are going to help us develop this pipeline and be able to do this in a well-managed situation. Net finance costs from 3 million up to 9.5 million. This is in line with the 60% increase in the actual debt. Realised foreign currency gains. We've had a big movements here. I'll touch on that just now. And then taxation, you'll see there. Because we pay tax through the structures in country, the 1.4 million is something that is going to be in our results, but it's important to note that we don't do a REIT distribution at the end of the day. The tax that you'll pay on your distributions here is 15%, not the 41% as to individuals from the normal REITs. Just on the once-off costs, this year the realised foreign exchange gains relate primarily to Mozambique. What we're finding there is we've got a very big pool of costs that are actually in the local Meticash. So when we get our actual dollar gains in country, we are holding all those rental incomes in hard currency US dollars. We are then in a position where we need to sell roughly 18% of our dollar generation to cover the local costs. Things like VAT, taxes, municipal taxes, all of these costs are denominated in Meticash. What happens is we pay those costs anything from 30 to 60 days after they're actually incurred, and we're actually getting very big gains from the 66% loss in the Meticash. For the Anfa shopping centre, we have incurred some costs that are once-off in nature. We've had to provide a lot of concessions to the tenants. Because this is all based on French law and French leases, there's no typical relocation clauses in the actual agreements. It's absolutely critical that we get this tenant mix right, and that's why we've done some of these concessions. The other thing that happened is during the year we had a write-off of some old disputed invoices which come from the actual days when we bought the centre. We got to the end of our 2-year period with the developer and we've had to take a 0.7 million write-off there. In addition, some of the tenants that are going to be affected in the NPI Place shopping centre by the redevelopment, we are being a little bit more cautious on what we are holding as their debtors balance and made another provision of 0.8 million. When we look at the balance sheet, you'll see there the property investments from 210 to 294, current assets from 25 to 30 with a big increase in our cash balance, other current assets staying fairly constant. Debt, that's where we've made very big advances this year, 101 to 161. And the current liabilities, which is a big increase in line with the new properties that have come online during the year. When we look at our debt expiry profile, you'll notice there that we've got 2 debts that are going to be due shortly, or some have become due. Of the current debt, we've settled 2.8 million on the 29th of, sorry, 11 million on the 29th of July, and 2.8 million we've actually converted into a long-term loan, which was a bridging facility. The 19 million will be part of the refinance transaction when we're looking at the Zambian portfolio of assets, and this is going to come with a very attractive interest rate of 4% on LIBOR, which is quite a good news for us. If you look at our exposure in terms of currency, we've got euro and US dollar currency exposure. The euro exposure is actually as a result of the debt that we took out on the NPI Place shopping centre, where we've taken hard currency debt, which is in the same ratio as the dirham, which is a weighted currency, 60% to the euro, 40% to the US dollar. And we've got a small METS exposure, which is this $2.8 million loan. Weighted average cost of debt, I think we need to look at this in the context of rising LIBOR rates. We've come from 6.94 to 6.22 for the year, with a 5.66% June weighted average cost of debt. We're seeing that as the benchmark going forward, although we still see scope to drop that rate further. In terms of our debt composition, the bulk of our debt is actually term debt related to properties. We have a revolver facility to help with any liquidity events that may arise, and a small bridging debt. Of the fixed debt, our target is to keep 70% of that exposure fixed to interest rates. We've managed to achieve 63.6 during the year, and as we do more deals, that will move close to the 70%. As Bronwyn mentioned, we've got a very multi-banked approach. Last year, if you looked at that graph, it would have just been Standard Bank and Standard Bank Mozambique. We've managed to get very good relationships now with Banco Unico in country in Mozambique, Barclays Bank in Mauritius, as well as Afrasia, who's been a very big supporter of us, as well as Investec, who are now quite a big debt component of our debt. We still have very new relationships that are burgeoning with the Bank of China, who are looking at the Zambian asset pool, as well as Nedbank, who are entering into Africa at the moment. Bronwyn.
Okay, so just looking ahead, not looking ahead, looking behind there, sorry. Looking ahead, there we go. We just put these 2 slides in again, just to say why are we in Africa. And I think from our side is that we are in markets where we're seeing significant macroeconomic opportunities and growth. GDP growth, growth of people, requirements for shopping centres, requirement for office accommodation, having the ability to really look at some of these economies and tapping into that fundamental growth that we're seeing. And I think if you see some of these slides, you're still seeing the growth coming out of these markets. And what has now happened with the current challenges in Africa over the last 2 years, a lot of our competitors have either done not much or they're looking at exiting. And we still believe that there's huge opportunity and growth to utilize our current platform to expand our real estate business. And I think, what we are doing is that we're now seeing assets that were in the market, like the Japanese embassy, which is a very good transaction in Mozambique, that was marketed at a percentage yield that's now coming in better, over 10% in a dollar yield. So it's giving us great opportunities, being able to leverage off some of these macroeconomic opportunities. So the private equity money is still flowing hugely into Africa. It's interesting because we have roadshowed Mara Delta into the Middle East, into the UK. We've got some money coming out of the States into Mara Delta. We're looking at pension fund money across the continent. We've got one big pension fund that's looking at committing quite a large check into Mara Delta. And what the guys are seeing out of Mara Delta, they're saying, okay, there's proper dollar growth, there's proper dollar dividends, there's total return, there's growth, annual growth on that number. We are not taking development risk. We're going for the counterparty, the strength of the long-term lease. So that's becoming critical to a lot of these pension fund insurance companies that are looking for dollars. And they actually are sitting on a lot of dollars with not a lot of opportunity across the continent. Again, I think what's important is that we are in a risky environment. You know, when I have an investor phone me and say, oh, did I hear about this issue? You know, the challenge is, again, it's emerging frontier markets. And we are very cognizant of the risks. We live with risk every single day. We have a separate risk committee at board. We have employed a head of risk part of Mara Delta. We live with risk every single day. What we are going to do is we're going to produce a quarterly report for our investors on our geographies to just give them an update, because things change daily on the continent. So, you know, we have gatekeepers before we will go into an investment. Gatekeepers are made of things like, can we expropriate the funds? Hence why Nigeria is a big concern. Angola would be a big concern. Those were economies that we wouldn't look at investing into. Will a bank fund into geographies? The DRC, the bank won't fund. So, you know, again, our model works on debt funding. Being able to have that secure dollar or euro underlying currency. Should we be looking at signing up some of our shopping centre and local currency? So in Zambia, some of our moms and pops aren't kwacha. The reality, do you force those moms and pops type tenants to sign in hard currency? No, you don't, because they can't sustain it. So, you know, the reality is looking at funding structures, looking at geographies where we're able to tap into this GDP growth and mitigate risk as much as possible. So these are our range of risks that we look at. And as I reiterated, it happens on a daily basis. Just the platform and the growth platform. So what's important is that you cannot run this business from behind your desk in Johannesburg or in Mauritius. It's a very operationally focused, hard-driven business. So we have got a lot of people in these particular countries. We've got a lot of partnerships in these countries. We are fully domiciled out of Mauritius. You know, we couldn't take any risk of South African Revenue Services pulling our profits back to South Africa. It would be a huge risk. I sit out of Mauritius, the CFO sits out of Mauritius, the entire executive sits out of Mauritius. So it is critical. We own our offices in Mauritius. So we pay, and obviously subject to company tax in Mauritius, which is 3% in the process after the budget speech going to 0%. So it's very favorable. So we have not taken any SaaS risk in relation to running our business out of South Africa, which is imperative. You'll see that we have a very heavy executive structure. We've got Heidi, that's ex-Brol, MD of Brol. We've got Moira, a CIO, is not a chief investment officer, is actually a chief integrated officer. It's a term I've learned since being on the continent. When you go into these countries and you go into these jurisdictions, you need somebody to integrate you into the local operations, what is going on there. So Moira's specific job is actually doing the compliance and the integration into these jurisdictions. So just a quick case study, and I know we've gone on for quite some time, but this is a great case study. Again, it's in Mozambique, which is a tricky economy. This is an asset that we acquired at just over $32 million. It now sits at a valuation of $41 million. It is completely 100% USD long-term leases in place. It's Anadarko's head office. We're now doing an extension for 3,500 square meters. This is our asset focus. So Anadarko, a lot of you might have seen Anadarko when you've come on the road trip, which was as a site visit, which was very well supported. So Anadarko is one of our success stories on the continent. And the intention is to roll out as many of these Anadarko type assets going forward. Yield accretive pipeline. We are very cognizant that we are a dividend fund and that we have to be yield accretive with regards to our acquisitions. So you will see that we have parceled $163 million of acquisitions that are accretive to the fund going forward. And this is substantial growth. And we see the substantial growth coming forward. The structure of our fund is critical. The investor support is critical. The main shareholder base is critical. And we, again, believe with all the non-believers of Mara Delta. I think the challenge with Mara Delta, it didn't come out of one of the big four boys. It came out of Delta SA. Guys, we're not so sure. A lot of our competitors have been heavily critical of Africa, but we have created a successful platform now that will be able to leverage off these economies. And we've got an excellent team to now convert the $163 million of pipeline. And then post-portfolio overview, you'll see that we will now have, going into Uganda. Uganda, Kampala is one of my favorite cities in the world. I can't wait to take you guys there on a site visit. It's got a buzz, it's got people, it's got so much happening in that city. It's got traders, it's got people wanting to make money. So we are very excited. We've got an excellent partner in Uganda. We're very excited about our expansion into that particular jurisdiction. We see Kenya, not Nairobi necessarily, but outlying areas of Kenya. We find Nairobi extremely overpriced in some aspects. We're concerned around the Nairobi market, but there are outlying towns, Mombasa, Eldoret, Kisii, which are up-and-coming growing cities that we see huge focus on going forward. Again, I always get this question around what is your ideal asset type split? And I keep on saying Africa is not South Africa. Something always reminds me South Africa isn't Africa, but the rest of the continent is not sophisticated from a real estate perspective as South Africa is. The idea of creating specialized funds will come over time, but now counterparty. So you'll see that we have corporate accommodation. We don't want to get involved in residential, but if I have an Anadarko or a Vale or American Embassy lease, we will get involved in residential. So over time, there will be sophistication over the continent where you will see a retail fund or you'll see an industrial fund now. But we are more counterparty focused. So you'll see that that's where the components are. We show it out of interest, but at this stage, we have no target which asset class we want to be less or more exposed to. Prospects, my favorite slide. So I think what's critical is that the distribution grows. As tough as Africa is in the macroeconomic environment, we see 2 to 4% growth on that dollar dividend going forward. We are still seeing a total return at being able to achieve the 12% in dollars on the fund. Again, the cost of debt, really, the finance team couldn't have done a better job with regards to negotiating, and I hope this puts some of our funders in the room under a bit of pressure, makes your seat a bit warm. But the reality is that 5.66% is critical to maintain going forward. The access to the pipeline, what we are seeing, because we've delivered in some of these countries, we are seeing the pipeline coming to us. We are seeing so many opportunities. I think I've had a reputation previously for just buying up assets, but the reality is on the African continent is slightly different because we are seeing so many opportunities come across our desk and we turn away 60% of those. So when you see that $163 million, it's a properly selected pipeline which is yield accretive and strength of counterparty. The Wings Nigeria exit, we actually see that as a great prospect to us. I think it's not ideal that Pivotal has been sold to Redefine. Obviously, maybe ideal for Pivotal, but from us because they did have a solid Africa strategy. But for us, it gives us the opportunity to exit Nigeria and gives us the opportunity. We've had a couple of big shareholders looking at the Mara Delta stock who are wanting large stock quantum. So it gives us the opportunity to offload this 12%. Is it 12% they own? 12% into them. Risk mitigant, extensive PRI. We've got PRI, dollar liquidity, all of those things. That's why the banks are following us. I promise you it's not just because we're a nice-looking team. The banks like to be in these jurisdictions. But the fact of the matter is we've got PRI. And PRI obviously mitigates the ability to expropriate dividends as well as mitigates the risk around the actual debt that's sitting in the country. And just having a competitive advantage. Creating that platform that a lot of our peers have been unable to do over the last couple of months. So just on behalf of myself as the CEO, and I know we are broadcasting as well, and hopefully some of our Mauritian investors are listening, but just on behalf of myself and the executive and the chairman, thank you to a lot of our shareholders that have believed that we've been able to get this thing over the line. We believe we can be consistent with the results that we produce. We're extremely excited around the prospect of Mara Delta into the future. And, it's great to present to the JSE today. So thank you very much. So I know we want to take questions. So can I suggest that we actually take questions from the audience first? I know people could email in questions. I don't want to ignore them either. So if there are any questions, can I ask the room quickly first, and then we'll be able to go into the if anybody has sent through questions on the podcast. Any questions? Yes, sir. How can I help you?
Ms. Corbett, you stressed the importance of counterparties, untold times, and justifiably as well. When you first mentioned that icon, I assumed, probably incorrectly, that it goes way beyond dependence on good tenants. But am I incorrect? Is it only to do with the quality of tenants, or does it go beyond that into other areas?
So I'm hoping I'm going to answer your question correctly and I've understood it correctly. So one aspect is the strength of the counterparty, but other aspect is assessing if that counterparty can succeed in a country. So you'll remember the ShopRite story into East Africa. So ShopRite is a great counterparty, excellent, but it wasn't able to succeed in East Africa because you have the Nakumarts, you have a lot of big, good retailers that understand the East African market. So what's important for us is that, yes, you have a very strong counterparty and it comes to the retail side specifically, but has that retailer done enough to understand that market? Do they have distribution centers? Are they able, and I mentioned the example of Al Shire, which is a very strong counterparty into Morocco. They own the H&M brand, H&M, Starbucks, etc., but their price points aren't right. So as good as an H&M brand is, and it looks wonderful and the shop is wonderful, they're actually not necessarily doing well in Morocco because their price points. So they haven't been able to get their price points. And a lot of that has happened in Nigeria and a lot of the other countries. So I think for us is that the office counterparty is probably a little bit easier because you'll have the Barclays head office, you'll have the Standard Chartered head office, you'll have Anadarko, Shell, Total. These guys are driven by local commodities. They're driven by their own research going into these countries. The retailer side becomes a little bit more tricky. So I hope I've answered your question.
Leading off your answer, I'm now referring to the slide realized foreign gain, and also beneath that concessions, write-off and additional provisions, which total 2.9 million. I'm assuming that these tenants who are going to benefit from these various write-offs are still being held as tenants, and therefore one would question to a certain degree whether they are the right counterparties that you should have. And on that same point, where is the 2.9 million slotted into the income statement? Has it already been taken off net property income, or does it feature elsewhere?
Already taken off net property income. So to answer your question from the back, so net property income. So those concessions relate specifically to one shopping centre, and that's in Morocco. So Morocco, we own the Anfa shopping centre, and we are undergoing a significant upgrade at that particular centre. As Leon alluded to earlier, French law, which is interesting, doesn't deal with being able to relocate tenants in a particular shopping centre when you're doing the upgrade. That centre, when we acquired it, had all the top brands, and it was a top centre from a brand perspective, but not necessarily the right counterparty because those questions weren't asked. So when we bought that shopping centre, brands like that were coming out of some of the big international corporates aren't actually the right brands. So what we have discussed with a lot of them is that a lot of them we've downsized. So Marks & Spencer will give you an example. Marks & Spencer, which is a great brand, hasn't got the right shop fitting into Morocco, hasn't got the right range. We've got them to downsize, and now we've brought in 2 of the Turkish retailers that are going to take up part of that space. So to answer your questions, the concessions are granted to tenants that are still there. They're granted to those tenants to be able to re-look at their retail strategy within the centre, and we've provided a lot of guidance in relation to that retail strategy. So that is really, we call it a once-off, has come out of the upgrade and really reworking that asset. The redevelopment work and upgrade work that we had looked at doing was delivering quite an exceptional return. So it's to balance the write-offs versus the return that we're getting from the redevelopment work, but only relates to one particular centre. that Anfa Centre is not necessarily our normal strategy with regards to retail. Our sweet spot for retail is anything between 5,000 and 12,000 square metres. We see those successes have tremendous success across the continent, because when the market does have an issue, guys still need to shop, they still need to have their cell phone fixed. It's those luxury brands that suffer. So what we're seeing in Morocco is that those luxury brands are under pressure at the moment. And that even though Moroccans seem like very sophisticated individuals, France and Spain is a 35, 40-minute flight. If they want to go and have luxury brand shopping, that's where they go. They don't necessarily do it in your centre.
And finally, if you would please, could you give some background as to the reason for Pivotal's proposed exit?
So if there was an announcement that came out last week that Pivotal is actually being sold to Redefine. So this is in line with their sale to Redefine. So Pivotal, that had a very large Africa strategy, has now been disposed of in its entirety to Redefine. The transaction, I think, is effective sort of mid-October. Redefine has been very public. Mark Wayne has been very public that he does not like Africa at all, the rest of the continent. As you know, he's got a foray now into Poland. And so when we have had the discussion, he is not interested in having any Africa exposure, no matter how well performing it is. He's made a very public view. I think his shareholders would look at him very critically if he decided to suddenly go into Africa. So that is the exit.
I thank you.
There's a question over there. Oh, there we go.
This is Brian from Eskom Pension Fund. I'd like to commend you for a great set of results. Just could you please maybe unpack your growth in NPI? I see that's mostly acquisitive, right? What can you give me a sense of your organic growth on your existing portfolio, the pipeline?
The existing growth on the existing portfolio. So our existing growth on the portfolio is really driven by our escalations. And now you'll see with the Anadaka Phase 2, we're able to put in some development profit that would bolster that additionally. So our existing portfolio has grown in sort of between sort of 2 to 4%. That's the existing portfolio itself. What we've done is been very specific in reporting what that existing portfolio looks like plus the growth, because we don't want to be in a position, a lot of the South African funds on that, they have to keep on buying in order to get that distribution going. So we've been very focused on making sure that our current portfolio performs. As I mentioned, ANFA has been more of a challenge for us to see that growth, and that's why we're refocusing on getting those tenants in and that particular upgrade. But the actual existing portfolio sits between 2 and 4%.
Thank you.
Any other? It's so nice that you guys are asking questions. I think at the Delta one, nobody asks questions. I don't know if I should be insulted or... There's a gentleman behind you that's going to ask.
Morning, Bronwyn, and well done. Could I just ask something around funding the pipeline going forward on the sort of rough 50% split between debt and equity, and the raising of that equity, and whether you anticipate most of that being raised, continuing to be raised on the SEM as opposed to here? Just your views and thoughts around that. Because I suppose it has some bearing on the current shareholder base as well.
Yes, correct. So I think, specifically you guys have known my views quite strongly on this. Until that share price re-rates back on the JSE, we would not look at raising capital off the JSE. So we have been marketing this the fund through the SEM. And actually, there's some big shareholders that are going to be coming directly through the SEM that will fund that pipeline going forward. I think there's definitely room to relook at the capital structure going forward. This fund can't continue to carry that massive arbitrage, and liquidity is critical. So, we are looking at some instruments that we can put in to create some liquidity going forward. But most of this capital has been identified and will be raised through the SEM. And that SEM would obviously be raised at NAV, which is the $1.64. 64. So that just hopefully answered your question.
Hi, Bronwyn. Adrian from Avio here.
Hi.
Just one question on the Delta Property Fund shareholding around 24%. Do you have any comments on whether they'll look to reduce that stake or sell out within the sort of next 12 months? So if my worry is with Pivotal and Delta on top of that, you're looking at 37% of your shareholders potentially looking to sell out or reduce their shareholding. I saw Sandile here. Maybe you can comment?
No, he is here. and I'll try not to answer on his behalf because I'm no longer an executive at Delta. I'm now only on the board. So I think Delta's got, and Sandile might have alluded to it, has got a strategy session in relation just to where Delta's going to be positioned going forward. They have advised us to date is not their inclination to sell out of Mara Delta. They, unfortunately, where their share price is trading, though, that they can't support the rights issuance, if there's rights issuance or following of the capital going forward. So I think he's doing a lot from his positioning to get that share price re-rated. And I'm obviously standing on the sidelines cheering him on because the more he gets that share price re-rated, they have the ability to obviously go and follow from a Delta perspective, Mara Delta perspective. So I think from our side, Delta has not indicated that it's going to exit at all. It will probably be diluted as we do these capital raises. It has been diluted extensively already. What is critical for Delta, though, is that Mara Delta gives it a good dollar distribution and also gives it a good diversification from government. And Sandile has always been quite adamant around the diversification, that Delta SA needs a story around diversification from government. And I think with the platform that we're creating, we're able to do that for Delta South Africa. Obviously, the Pivotal exit is a bit unfortunate because I think Pivotal had a very strong Africa sort of mandate in going forward. But it actually works in our favour because, as I've mentioned, there have been some bigger shareholders that are wanting to get some nice stock, nice parcels, which has been a bit difficult to do because the PIC won't relinquish any of their stock. And Delta hasn't wanted to relinquish to date. So it does give us an opportunity to bring in one or two strategic shareholders. So watch the space. And
in terms, you've been seeing shareholders offshore in the Middle East and so on. What has the sort of appetite been for Mara Delta from offshore guys?
Yeah, so interesting. I had to educate. I've been in the States. I had to educate a lot of the guys where Africa was, firstly. But we actually got a big shareholder there that's actually got an Africa story. It was quite exciting. And they've invested in one or two other Africa stocks that is coming into the stock. We'll hopefully close them out in the next month or two. They're just undergoing DD. The States is a bit difficult. We are seeing interest out of the UK and the Middle East, though. So we bring in some shareholders there. But what's been interesting is the pension fund and insurance capital sitting out of Mauritius as well as on the continent. So a lot of guys are sitting on dollars, but they don't have platforms. So like the stocks in Mauritius are rupee stocks. Those rupee stocks, I think, are trading at sort of 2 to 3% growth. We've got one of our competitors sitting on the Mauritian Stock Exchange. So, Mara Delta has far exceeded a lot of those real estate stocks. So we're seeing a lot of interest in what we have done because of the arbitrage. And, South African investors are still anxious about Africa. They are saying, we need to see 10 to 11% dividend sort of forward yield, even though even on the South African register it is sitting quite attractive. But the reality is with the tax and the post-tax structuring, it becomes very difficult to achieve those. And I think, again, if you look at the sort of counterparty and the strength of the real estate stock going forward, they probably need to take a slightly different view on Africa. Yes, Tony.
You mentioned earlier that hospitality is not on your radar at the moment, but have you ever given thought to business hospitality that lines up with your office offerings?
So I say hospitality is not on our radar. It's not on our radar in relation to taking hospitality risk. So we will look at sale and leaseback opportunities. And interesting enough, you've mentioned that we've been approached by a business hotel that would like to expand into Kenya that's looking at leases. So if we will get a lease from an operating company, we will then look at the transaction. I'm not, and I was saying to one of the CEOs of one of the hospitality funds in Mauritius, I can't be knocking on his door saying, what's going on in your hotel? You're not making the numbers and we've got an X percentage of your turnover. So, they need to be comfortable around the lease. And it's interesting enough, a lot of them are becoming comfortable with that because they obviously need the cash to inject into their projects going forward. I love business hotels on the continent, including Mauritius. Even if you look at some of the areas that we are in, we're lacking business hotels. So there's a huge opportunity. But again, we will only do it on a sale and leaseback if we have a lease. We won't take a management contract over the asset. Yes. I can come back to you.
Thanks. I'm going back to the income statement. I have two questions. The first one refers to the antecedent dividend of 636,000. how was that derived? And if it is antecedent, why wasn't it included last year or the year before?
I'll let Leon answer that question.
In terms of Mauritian law, approval in order to have capital, which we didn't have in last year.
Okay.
So we've managed to get that this year. The key there is to ensure that the distributions to our current shareholders are never going to be impacted by raising more capital, which is why we wanted to follow that route.
All right. And secondly, please, I want to link the cash holdings of 17.75 million. I'd like to know where that money's parked. And in the absence of a cash flow statement, I'm going to assume that you've earned very little interest on a dollar amount. Can I therefore assume from the income statement that the net finance costs are essentially interest paid in full, that 9.5 million?
About 98% of it is interest paid.
Okay.
Yeah, but actually we park excess cash in revolvers. So that's why we have a revolver facility. So you draw down on your revolver, and then what we do is we park excess cash in that revolver. So that revolver facility will sit. What is our Fraser revolver facility interest rate?
5.4.
5.4. So effectively we park it in there. So your first part of the question isn't correct, but your second part is.
Thank you.
Okay. Are there any other questions that I can take from your side up there?
Any calls on the? Any questions on the call?
We have beautiful music, right?
And any questions on the webcast?
Yes, my apologies. There are no questions on the lines.
No questions. Oh, fabulous. Thank you. The entire Mara Delta team is here today. I should have put you all in red Christmas hats so you could identify yourself. So if you've got any questions, please ask everybody. And thank you again for attending today. If there are any questions, management is available. We'll be seeing some of you over the next few days. And thank you, Sandile, again for joining us, and the rest of the team and our investors and funders. Thank you.